Hello guys, in today's video we'll discuss about the Ichimoku indicator. I'll show you how to correctly read and take signals, and we'll also see some tips on how we can improve our winning ratio by trading with the Ichimoku cloud. An Ichimoku chart is a trend following system with an indicator similar to moving averages. Ichimoku is one of the trading indicators that predicts price movement and not only measures it. The advantage of this indicator is the fact that offers a unique perspective of support and resistance. For most traders, Ichimoku might seem complicated, but once you get familiar with how to interpret the charts, you'll spot some great trading signals. I'll try to keep things short and simple so we don't overcomplicate things. First, we have the conversion line. This is a short-term line, also known as a turning line. This signals an area of minor support and resistance. So if you're all about short-term or scalping, you must follow the conversion line. Second, we have the baseline, also known as a confirmation line, and serves as a signal for support and resistance levels on medium term. Some traders use the baseline as a trailing stop level. Then we have the lagging span, also known as the lagging line, used for the confirmation of signals. The lagging span can also serve as a support and resistance level. Then, maybe the most important tool of Ichimoku indicator, we have the Kumo cloud. I don't want to bore you with the numbers or periods based on which the cloud is calculated. All you need to know is that the cloud is formed from two lines, span A and span B, which act as a major areas of dynamic support and resistance. Now that we saw the main components, let's see how you should read the Ichimoku chart. As I said before, the conversion line measures short-term price movement. If the market price is above the conversion line, this suggests a short-term upward momentum. If the price is below the conversion line, this suggests a short-term downward momentum. An increasing conversion line indicates an upward trend, and the decreasing conversion line indicates a downward trend. Now, the baseline represents medium-term price movement. If the market price is above the baseline, this suggests a medium-term upward momentum. If the price is below the baseline, this suggests a medium-term downward momentum. An increasing baseline indicates an upward trend, and the decreasing baseline indicates downward trend. Next is the lagging span. This line indicates the big picture of the trend, the evolution of the current price action in relation to previous price action. When the lagging span is above the current price, this indicates that current prices are higher than previously and suggests a bullish bias. When the lagging span is below the current price, this indicates that the current prices are lower than previously and suggests a bearish bias. When the lagging span is near the current price, this indicates a trading range. And finally, the Kumo, plotted as a cloud, indicates dynamic support and resistance based upon price action. The longer the price stays below or above the Kumo cloud, the stronger the trend is. When the cloud is wide, the expected support or resistance is strong. When the cloud is thin, the expected support and resistance is weak. You should never trade inside the Kumo cloud. That's a very important rule. Now let's see how we can trade with Ichimoku based on what we've learned so far. The first strategy involves baseline and conversion line crossover with the lagging line as a filter. The crossover between the baseline and the conversion line can offer trading opportunities in a similar fashion to a moving average crossover. When a fast moving baseline crosses above the slower moving conversion line, we have a buy signal. When a fast moving baseline crosses below the slower moving conversion line, we have a sell signal. We could filter the signals received with the lagging span for safer entries. Thus, we could only take positions that are in line with the overall trend. If the baseline crosses above conversion line, you would only buy if the lagging span indicates a bullish bias. If the baseline crosses below the conversion line, you would only sell if the lagging span indicates a bearish bias. Another similar strategy involves the baseline conversion line crossover, but the filtering technique takes into account the Ichimoku Kumo cloud. When a baseline crosses above the conversion line above the Kumo cloud, we have a strong buy signal. When a baseline crosses above the conversion line below the Kumo cloud, we have a weak buy signal. When a baseline crosses below the conversion line below the Kumo cloud, we have a strong sell signal. And when a baseline crosses below the conversion line but above the Kumo cloud, we have a weak sell signal. Another trading technique involves the Kumo cloud breakout. This signal occurs when the price cuts through the Kumo cloud. When the price enters the Kumo cloud and breaks its upper wall upward, we have a bullish signal. And when the price enters the Kumo cloud and breaks its lower wall downward, we have a bearish signal. The crossover between the span lines forming the Kumo cloud is another trading strategy used by traders in a similar fashion to a moving average crossover. However, we must take into consideration that the lines of the cloud are projected forward by 26 periods. When span A of the Kumo cloud cuts the span B from below to the upside and prices are positioned above the Kumo cloud, we have a strong buy signal. When span A cuts the span B from the upside to the bottom and the prices are positioned below the Kumo cloud, we have a strong sell signal. When span A cuts the span B from the bottom to the upside and prices are positioned below the Kumo cloud, we have a weak buy signal. And when span A cuts span B from the upside to the bottom and the prices are positioned above the Kumo cloud, we have a weak sell signal. All in all, the Ichimoku is an interesting indicator, excellent at offering dynamic support and resistance levels. Its main advantage is the fact that it's good at measuring the direction and intensity of the current market trend. Just be careful and use it in trending conditions, because during non-trending markets it will offer a lot of false signals. If you got any value from this, please consider subscribing to our channel, share and like this video, as it will help us a lot in the future. Until next time.